This is Business 33, Exam 2 Review. This is the second video on Chapter 8. The first question is, what are the purposes of budgeting? Well, what is a budget? It is a detailed quantitative plan for acquiring and using financial and other resources over a specific forthcoming time period. Two key purposes are planning, which involves developing objectives and preparing objectives, then preparing various budgets to achieve those objectives. For example, in Chapter 7, we did talk about the two different costing systems. For example, the activity-based costing system versus the traditional costing system. Both would create two different types of budgets, which is why they both have positive and negative aspects to them. And then control, which involves the steps taken by management to increase the likelihood that the objectives set down while planning are set down and that all parts are attained, along with all parts of the organization are working towards that goal. So how are they made and why are they made? Well, to improve the efficiency and effectiveness of the operation and to evaluate and reward employees. Budgets are extremely important and there are different types of budgets. In Chapter 8, there will be a major part on the master budget, which has multiple different parts. And right as we go, what is the sequence of preparing a master budget? Now, this can get pretty confusing, but here's how I remember it. Yes, they're in two boxes, but think about it like this, right? Sales budget goes down to a production budget. Production budget works with an ending inventory budget because one has to work with the other, because how are you supposed to know what everything costed and what the end of materials were if you don't have the ending inventory budget? All right, and then the production budget, which is multiple things in one time. Well, of course, with production and a product, you need direct materials, direct labor, and manufacturing overhead. So of course, there's your next tier, the top three. The third tier, direct materials budget, direct labor budget, and manufacturing overhead budget. The tier below that is the cash budget, which everything leads up to your cash, right? Your product makes you money, and then buying the material for that, well, you just have to pay the money for it. So you have to look at what everything turned out to be. Budgeting income statement and budgeting balance statement come next. But here's the interesting part. The budgeting income statement is not affected by the budgeting balance sheet, but the budgeting income statement affects the budgeting balance sheet. So as you can see, the budgeting income statement points straight to the budgeting balance sheet, but it doesn't work vice versa. That's because most of these things work one way. Now, for the selling and administrative budget, it's kind of strange because the sales budget does get affected by the selling and administration budget, and you would think that it would go with the manufacturing overhead budget, but it doesn't. Here's why. Because selling and administrative budget doesn't necessarily mean that they're at the actual facility where the product is being made. Of course, those things are still considered in the budget because it pertains to the product, and it affects the cash budget as well, such as sales, how much it costed with administrative and labor budgets, things such as that. So of course it has to be included. So that's why you see it on the far side, but it's still connected to the sales budget and the cash budget. Now the sales budget goes all the way around this whole figure and also ends up in the budgeted income statement. It's a little confusing, but it slightly makes sense. So first, create your budget. Examples of how to do this is you have your product levels, material costs, customer demands, staffing levels, and overhead costs along with revenue. So for example, you can see the percent. So say for example, in April, you only collect 70%, and then in the following month, you collect 30%. Well, of course, you would split the accounts receivable because you can't take the whole amount in the 1 month. It doesn't work the same. Second, create your product budget. The product budget must be adequate to meet budget sales and to provide for the desired ending inventory. So for example, budgeted sales. First, you add your desired ending inventory, which is the budgeted May sales. So this is April. So you bring down from May to April and you times it by 20%. So you get $10,000. And then for March 31st ending inventory, you subtract that to the total needs, which is the result of the budgeted sales with the desired ending inventory. And of course, in the problem itself, it'll tell you what the desired ending inventory percent is, just like it does within the expected cash collection. Then it's split with the 30% in the next month. Same thing happens here. It's kind of like a puzzle. Next, you create a materials budget, so whether you're manufacturing product to sell or just buy them for resale, you'll need to create a materials budget which will directly tie to your sales budget. So down below, we have the production, so the amount that was produced, the materials per unit, so it'll also tell you this in the problem as well. Now here's the interesting thing. At desired inventory, it will tell you that it has to be a certain amount of the following month's production needs. So that is why it's recommended that you actually finish the top tier, which is production and materials per unit. That way you're able to easily do the math and do the percent of the following month. That way it's easier to finish what that next month is going to be. And then you also have to add less beginning inventory. So the month before that, you have to add the beginning inventory. Here's one more example. Basically, you use the number in two different areas at two different times because you're using the previous month and you're using the ending amount of the month. Next, create a direct labor budget. If you purchase goods for resale, you can skip this step. All right, so if it's a resale kind of situation, then you don't need to do this. But in most cases, you will need to do this. So units of production, direct labor time per unit, labor hours required, times the hourly wage rate, and then you get the total direct labor cost. Next, you create an overhead budget. This step will help you account for both fixed and variable costs in production while including direct materials and direct labor since each of those has its own budget. Next, account for cost of goods sold. Using the information from the sales budget, materials budget, and production budget will simplify the creation of the cost of goods sold. You'll also need to include budgeted beginning and ending in inventory in the cost of goods sold. Next, create an administrative budget. Should include all non-manufacturing costs your budgets will incur, such as supplies, sales, and shipping or freight costs, as well as front office salary. And then 8, create your financial budget. Consists of a cash budget that displays cash inflow and outflow based on the operational budgets created earlier, a budgeted balance sheet also based on operation totals, and a budget for any capital expenditures expected in the upcoming fiscal year. So this is like we have seen in the first part of cash dispersal. And it's, again, based on the percent per month. And it will tell you this in the actual equation, but you're doing half and half for this example. And then finally, the fun part, create your master budget, which goes off of all of the final amounts that you had in your following budgets. Alrighty, and that is all of chapter 8. Make sure to like and subscribe for more videos. And of course, comment if you have any questions. There will be another video out for chapter 9 and then one more video out for more practice problems.